Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 1-3. This is a multiple choice paper which consists of 30 questions and each of them will be of 1 mark, and the total time limit given for this paper is 1 hour. So in this video as well, we'll be attempting to solve this paper under 1 hour. Without any further delay, let's get started. For the first question, we need to figure out what are the advantages of being in a partnership. The first one is all partners have limited liability. This is incorrect because in a partnership, all of the partners will have unlimited liabilities. The second one is responsibility for running the business is shared. This is true because if you're operating as a sole trader, then all of the responsibilities have to be fulfilled by a single person. But if there is partnership, then the responsibilities can be shared among the partners. The third one is shares can be sold. This is incorrect because there are no shares in a partnership. Then the fourth one is the business has access to more sources of capital than a sole trader. Again, this is correct because as a sole trader, you'll be a single person investing in that company. Whereas if you form a partnership, then it means that different partners will come together in order to run the partnership. So there will be multiple sources of capital. So the correct answers are 2 and 4, which is given in option D. Let's move towards the second question. Which statement about the purpose of a trial balance is correct? Remember that we prepare a trial balance before preparing our financial statement. So the main purpose of trial balance is that it will help us prepare the financial statements, and that is given in option A. Let's have a look at the remaining options as well. The second one is that it ensures that all double entry postings to ledgers are accurate. Remember that there can be error while posting the balances from ledger to the trial balance. We can write the balances of 365 as 356. Those are the kind of errors. So it definitely does not ensure that all our postings to ledgers are accurate. This is incorrect. The third one is that it ensures that all postings to books of prime entry are accurate. Again, it can be incorrect. There can be errors of original entry, right? So this is incorrect as well. And the last one is that it shows that all the transactions in a period have been recorded. There can be errors of omissions, which means that we can completely forget to record a transaction. So this is incorrect as well. Let's move towards the third question. The accounting equation of a business was as shown, where given assets equals to liabilities plus capital. This is our accounting equation. And the assets included a bank balance of 1,000. Okay, the following transactions occurred. Now we need to figure out the accounting equation after these transactions. Okay, so we have 48,000 equals to 7,000 plus 41,000. And remember that all of our transactions will have a twofold effect. So it will have to affect two of these 3 items, or it can affect the same item but twice. The first one is that the owner took drawings of 2,000 by check. So this is drawing of cash, right? And this is of check, which means that we need to deduct 2,000 from our bank balance. But remember that our initial bank balance is of only 1,000. So from our asset itself, we can only subtract 1,000 because that is the balance in our bank. Then the remaining 1,000 drawn will be shown as our bank overdraft, which is a part of our liability. So we need to add that 1,000 to the liability. And also remember that the drawings of check will be subtracted from our capital. So that will be minus 2,000. So the effect on both sides are equal. That's negative 1,000 here, and that's positive 1,000 minus negative 2,000, which is again a negative 1,000 on our liabilities and capital side as well. For the second transaction, where given goods for resale were purchased on credit, the list price was 4,000 less 25% trade discount. So the price of the credit purchase is actually 4,000, and we have to subtract 25%. That gives us 3,000. So we purchased 3,000 worth of goods. And remember that these are the goods for resale, which means that we need to record this as part of our inventory in the assets section. So we need to add 3,000 to our assets. Now, these are purchased on credit, which means that we also need to record this as our trade payables. Trade payables will be a part of our liabilities. So we need to add 3,000 there as well. So both sides will be affected by positive 3,000 for the second transaction. Now we can figure out the total. So the total for our assets will be 48,000 minus 1,000 plus 3,000, which results in 50,000. For our liabilities, that will be 7,000 plus 1,000 plus 3,000, which is 11,000. And for our capital, that's 41,000 minus 2,000, which results in 39,000. So this is our final answer, and this is given in option C. Let's move towards the fourth question. We need to figure out which item is revenue expenditure. Remember that revenue expenditure are recurring expenses. these are the expenses that will occur time and again. So for the first option, we're given installation costs of machinery. Remember that once the machinery is installed, we do not have to install it time and again, which means that these are not recurring expenses. These are non-recurring expenses, so it cannot be revenue expenditure. The second one is legal fees on the purchase of premises. Again, this legal fee will only have to be paid once during the purchase of premises. It will not have to be paid time and again, which means that this is a non-recurring expense. So this cannot be revenue expenditure. For the third one, we have number plates on a new motor vehicle. So we only need to spend on number plates once, because once we have those number plates, we do not need to change it time and again. Again, this is a non-recurring expense which cannot be revenue expenditure. And the fourth one is redecorating office premises. This is redecoration, which means that we can decorate it time and again, which will make this a recurring expense, which is revenue expenditure. That's the correct answer. Let's move towards the fifth question now. On 1st January, the owner of a business purchased a new machine. All non-current assets are depreciated by 25% per annum. During the year, the following payments were made in respect of the machine. So we're given the cost of machine, we're given delivery, we're given installation, we're given 1 year's insurance. Again, we need to utilize our concept of revenue expenditure and capital expenditure in this case. Delivery will be done only once, so this will be our capital expenditure. Installation will only be done once, so this is also our capital expenditure. But insurance, we have to do it every year, so this is our revenue expenditure. And capital expenditure needs to be included as cost of that particular non-current asset. So the total cost will be 16,000 plus 400 plus 600, which is 17,000. That's the cost of the new machine. Now, a charge of 5,100 for these items was included in the draft statement of profit or loss for the year ended 31st December. So we need to figure out the correct charge. And these are the charges as part of our overhead in our statement of profit or loss. So the very first thing that we will include is our depreciation. We've already figured out the cost to be 17,000. So that's 17,000 times 25%. That's our depreciation. And we also include the insurance charge as part of our overhead. So that will be plus 100. So this gives our depreciation charge for the year to be 4,250 plus our insurance of 100, which gives the correct charge as overhead towards our statement of profit or loss to be 4,350. But we charged 5,100, which means that our overhead was overstated. So overhead overstated. Let's figure out the overstatement amount. So that is the difference, 5,100 minus 4,350, which results in 750. So if our expenses are overstated, it means that our profit will be understated by the exact same amount. And in the question itself, we are asked that how much was the profit for the year understated by. So that is just going to be 750 given in option C. Let's move towards the sixth question. What is the purpose of providing for depreciation? So remember that we provide for depreciation to show the expense for the revenue that we have generated from the use of that particular non-current asset during the year. So we're applying matching concept here. We're matching the revenue generated by the use of non-current asset to the expenses of that particular non-current asset. And that is given in option A. Let's move towards the seventh question. A business purchased a vehicle which had cost 27,000 and had an estimated residual value of 1,000. Depreciation of 18,200 has been charged on this vehicle. Now the vehicle was sold in part exchange for a new vehicle which cost 29,500. A check for 19,000 was paid in settlement of the transaction. So the new vehicle was purchased for 29,500, and for this a check payment was made of 19,000. The remaining value was settled by the part exchange. So let's figure out the value for part exchange. That is just the remaining value, 29,500 minus 19,000, which results in 10,500. So this is our part exchange value or the sales proceeds for the disposed vehicle. Now we need to figure out which profit or loss was made on the sale of the vehicle. So we already have our sales proceeds, right? And in order to figure out whether there had been a profit or loss on disposal, we just need to figure out the net book value of the disposed asset. And we're told that depreciation of 18,200 had been charged on that vehicle and the cost was 27,000. The formula for depreciation is cost, which is 27,000, minus the accumulated depreciation, which is 18,200. This gives the net book value to be 8,800. So we can clearly see that our net book value is lower than the sales proceeds or the part exchange value, which means that we got higher amount than what we anticipated for, which results in profit. Let's figure out the profit amount. That is just going to be the difference between the sales proceeds and the net book value. So 10,500 minus 8,800, which results in 1,700. So that's a profit of 1,700 given in option C. Let's move towards the 8th question. The totals of a trial balance did not agree and the following errors were discovered. We need to figure out which errors would have led to the trial balance totals being different. So the first one is a check of 27,000 for the sale of a non-current asset had been credited to the sales account. The corresponding entry was correct. So this will not result in the trial balance totals being different, because remember that check of 27,000 for the sale of non-current asset is our income which had been credited, and we credit all of our incomes, but this had been done to a different account. But it does not matter because the totals will still remain the same. For the second one, we're given the purchase on credit of a new motor vehicle of 27,000 had been omitted from the supplier's account. The corresponding entry was correct. So this was not omitted completely. This was only omitted from the supplier's account, which means that our supplier's account will now be understated, which will result in the trial balance totals being different. So this is true. For the third one, we're given entries in the cash book for a transfer from cash to bank for 27,000 had been reversed. So this reversal will not really have an effect on the trial balance totals, because both cash as well as bank is our asset which will be recorded on the debit side. So regardless of these accounts being reversed, the entry will still be recorded on the correct side of our trial balance. This is incorrect. Then the fourth one is that the purchases account had been overcast by 27,000. So if the purchases account had been overcast by 27,000, it means that our expenses will be overstated by 27,000, which will result in the trial balance totals being different. This is correct. So we're looking for 2 and 4, which is given in option D. Let's move towards the 9th question. A suspense account had a balance of 450 debit. So what this means is that we're looking for 450 on the debit side of our trial balance as part of the correction of that particular error. Now we just need to figure out what caused this balance in the suspense account. So we'll look at the correction of each of the following, and then if the correction entry is 450 on the debit side in our trial balance, that will be the correct answer. So for the first part, we have motor vehicles of 225 correctly entered in the cash book and posted as motor expenses as a credit. So it means that instead of putting down 225 on the debit side, we put 225 on the credit side. So the correction for this, if we record 225 on the debit side once, then it just gets cancelled out with the previous entry of 225 on the credit side. So in order to rectify this error, we again need to enter the same amount of 225 on the debit side, so that once it gets cancelled out with the previous amount and once it shows the correct motor expenses. So the total on the debit side will be 450, which is what we're looking for. So option A is the correct answer. Let's have a look at the remaining options as well. Motor expenses of 225 entered in the cash book as a receipt. So this is an expense which should have been entered as a payment, and remember that our cash book is a book of prime entry. So this is an error in the book of prime entry which we can consider as error of original entry, which will not be disclosed by the preparation of the trial balance. So this will be incorrect. The third one is motor expenses of 450 correctly entered in the cash book and posted to motor vehicles as a debit. So we posted it to the debit side, which means that we treated this 450 as an expense, which is an expense itself. So we treated it correctly, but just under a different heading. And this will again not be disclosed by the preparation of trial balance. So this is incorrect. The fourth one is motor expenses of 675 entered in the cash book as a credit of 225. So there has been an understatement of our cash book, which means that our cash balance is understated. And remember that cash is on the debit side, and posted to motor expenses as a debit of 225. So we have recorded it as part of our motor expenses, but that is also understated. Okay, let's figure out the understated amount. That's 675 minus 225, which results in 450. But the 450 has been understated twice. So in order to rectify this error, we have to record 450 twice on the debit side, which would have resulted in 900 and not 450. So again, this is incorrect. Let's move towards the 10th question. What is the benefit of preparing a bank reconciliation? So when we prepare a bank reconciliation, remember that the bank reconciliation statement will include items such as unpresented checks and outstanding bankings. So the main purpose of preparation of bank reconciliation is to identify those differences under the heading of unpresented checks and outstanding bankings. And that is given in option A itself, to identify differences between the cash book and bank statement. That's the correct answer. Let's move towards the 11th question. A bank statement shows a credit balance of 1500. Credit balance means that this is positive. Now we need to figure out the cash book balance. Again, we need to prepare our bank reconciliation statement. Since we're starting with the balance as per our bank statement, we need to subtract all of our unpresented checks and add all of our outstanding bankings. And this will give our balance as per the cash book or the cash book balance. Okay, let's start with the balance as per our bank statement, that's 1500. And the receipt of 1250 were included in the cash book but have not yet appeared on the bank statement, which means that this payment of 500 is unpresented check and this receipt of 1250 is outstanding bankings. So we just need to subtract the 500 and add 1250. Then bank interest payable of 1100 had been correctly recorded in the cash book, but due to a bank error had been recorded in the bank statement as 1000. So this is definitely an expense, right? And instead of including the entire expense of 1100, we only have included 1000. So we're missing 100 payment. So we can just categorize this as unpresented checks and subtract this. Now we'll get our correct cash book balance, which will be 1500 minus 500 plus 1250 minus 100, which results in 2150. That's given in option C. Let's move towards the 12th question. A business is preparing a sales ledger control account. We need to figure out which of the following statements are correct. The first one is that all sales are debited to the sales ledger control account. So it's true that we debit our sales, but not all sales. We only debit all of our credit sales. So this is incorrect. The second one is that the contra entries are credited to the sales ledger control account. That is true. The third one is discounts allowed are credited to the sales ledger control account. That is true as well. And the fourth one is the allowance for irrecoverable debts is credited to the sales ledger control account. This is incorrect. We do not credit allowance for irrecoverable debts. We only credit irrecoverable debts. So we're looking for 2 and 3, which is given in option D. Let's move towards the 13th question. At the end of a financial period, the total of the individual balances in the purchase ledger was 149,000. The following errors were then discovered. We need to figure out what was the corrected total of the individual balances in the purchase ledger at the end of the period. So we can just prepare our purchase ledger control account and figure out the correct balance. Of 149,000. We start with the opening balance of 149,000, which goes towards the credit side in case of our purchase ledger control account. Then for the first one, a contra for 2500 had been omitted from a supplier account. And remember that the contra will be recorded on the debit side in case of purchases ledger control account. So we just need to record 2500 there. Then discounts received of 1200 had been credited to a supplier's account as 2100. So instead of showing 1200 as part of our discount received, we included 2100 as part of our credit purchases. So first of all, we need to reduce our credit purchases by 2100. And remember that the credit purchases will be recorded on the credit side, which means that we need to subtract or include this 2100 on the debit side so that it's subtracted properly. Then we also need to show 1200 as part of our discounts received, which will be recorded on the debit side. Now, no entries had been made for a credit purchase of 5100 from a supplier. Like I said before, credit purchases will be recorded on the credit side. So that will be 5100 right there. Then purchases returns of 3000 have been credited to a supplier's account. Again, purchases returns would be recorded on our debit side. But instead of recording this as purchases returns, we recorded 3000 as part of our credit purchases. So we need to subtract it from credit purchases. In order to do so, we just need to record it on the opposite side. So that's 3000. Now this will cancel out with the previous error of 3000 on the credit side, but we also need to show 3000 as purchases returns. So we need to record it again on the debit side. Alright, now we can figure out our correct balance. For that, we first need to figure out our total from the credit side. That's 149,000 plus 5,100, which results in 154,100. Now, in order to figure out the balancing figure, we just need to subtract all of these from the total. In this case, that's 154,100 minus 2,500 minus 2,100 minus 1,200 minus 3,000 minus 3,000, which results in 142,300. That is given in option A. Let's move towards the 14th question. A statement of financial position at the end of the financial year showed the following information. Okay, capital at the start of the financial year was 19,100. Profit for the year was 9,200. We need to figure out owner's drawings for the year. Okay, so remember that we start with the opening balance of our capital account. Then we add all of our profit for the year. Then we subtract all of our drawings, which gives our closing balance for the capital. Okay, in this case, we're given the capital at the start of the financial year, which is our opening balance, to be 19,100. We're given profit for the year to be 9,200. We're trying to figure out the drawings. Now we only require the closing balance of our capital. So for that, we have to look at this information. We're given non-current assets, trade receivables, inventory, trade payables, bank, which is credit. So this is basically our bank overdraft. And all of these are the end of the financial year balances. So all of these will be our closing balances. Now let's figure out our closing capital balance with the use of our accounting equation. So we have our non-current asset plus current asset will be equal to our capital plus non-current liabilities plus current liabilities. So the non-current asset is 18,000. Trade receivables is 3,000, which is part of our current asset. We have inventory, which is also a current asset. Then we have trade payables and bank overdraft. Both of them will be our current liabilities. So that's equals to capital plus 3,600 for trade payables plus 350 for bank overdraft. And we're not given any information regarding non-current liabilities, so we just assume it to be 0. So our capital or the closing capital balance will be 18,000 plus 3,000 plus 1,800 minus 3,600 minus 350, which results in 18,850. Okay, now we can easily figure out the drawings. That is just going to be 19,100 plus 9,200 minus 18,850, which results in 9,450. This is given in option D. Let's move towards the 15th question. In the absence of a partnership agreement, the Partnership Act 1890 might apply. Which statement is not correct about the provisions of the Partnership Act 1890? The first one is drawings are not allowed. This is not true. Drawings are allowed. Only the interest on drawings are not allowed. So that is the correct answer because we're looking for the not correct statement. Let's have a look at the remaining options as well. Interest on capital is not allowed. This is true. Profits and losses are to be shared equally. That is true again. And salaries are not allowed, which is again true. So our correct answer is still going to be option A. Let's move towards the 16th question. Victor and Wasim are in partnership. At the start of the financial year, the balances on the partner's current accounts were Victor 22,500 credit. So this is the amount that Victor will get from the partnership business, and Wasim it's 3,700 debit, which means that this is the amount that Wasim needs to pay to the partnership. The following information is available for the year. We need to figure out the balance on Wasim's current account at the end of the financial year. So let's prepare Wasim's current account. We have the opening balance to be 3,700 debit. That goes on the debit side. Then we're given interest on capital. So interest on capital is something that the partners will receive from the partnership. So Wasim will receive 1,700, and all of our receipts will be recorded on the credit side of our current accounts as well as the capital accounts. So that's 1,700 on credit side. We then have share of profits, which again is something that the partners will receive. So that goes as part of our receipt on the credit side. We have drawings, which Wasim will need to pay to the partnership. So this is our payment, which goes towards the debit side. Then we have interest on drawings, which is again something that the partners will have to pay to the partnership. So this is a payment, which will go towards our debit side. Then we have capital introduced, which will be recorded on the capital account, not the current account. Okay, now we can figure out our closing balance. We can clearly see that credit side is the heavier one. Let's figure out the total. That's 1,700 plus 97,500, which results in 99,200. Now, in order to figure out our closing balance, we just need to subtract all of these from the total. That's 99,200 minus 3,700 minus 17,500 minus 525, which results in 77,475. That is the answer we're looking for, which is given in option B. Let's move towards the 17th question. Which item would not be included on the statement of financial position for a limited company? The first one is issued share capital, which will be included as part of the equity. The second one is proposed final dividends. This will not be included in our statement of financial position, so this is the correct answer. Let's have a look at the remaining options as well. We have revaluation reserve, which is also part of the equity, which will be recorded. Then the share premium account is also a reserve, which will be part of the equity. Let's move towards the 18th question. The equity section of the statement of financial position of a limited company at 1st January is shown. So this is our opening balance. Now, how much cash was received from the rights issue? Okay, on 28th February, the company made a rights issue of 1 new share for every 3 existing shares. So for every 3 ordinary shares, we provided 1 new rights share. Let's figure out the number of shares from our opening balances. In order to figure out the number of shares, we just need to divide the value of ordinary shares by the nominal rate. So that's 450,000 divided by 2, which gives 225,000. Okay. Now for 1 ordinary share, we'll be providing 1 by 3 rights shares. And we've figured out that we have a total of 225,000 ordinary shares. So for 225,000 ordinary shares, we'll be providing 225,000 divided by 3 rights shares, which is 75,000 rights shares. Okay. And this was held at a premium of 1.50 per share. This is only the premium, and we also have the nominal rate of 2. So the total rate for the rights issue is 2 plus 1.5, which results in 3.5. And we just need to figure out the total cash received. For that, we only need to multiply the number of rights shares, which we already figured out, with the value at which the rights shares will be issued. So that's 75,000 multiplied by 3.5, which results in 262,500. This is given in option C. Let's move towards the 19th question. Which stakeholders use the financial statements to assess whether a company is a reasonable credit risk? So credit risk just means that if that particular party has some cash given or to be taken from the particular company, then credit risk is the risk of not getting that cash back. So we're looking for that kind of stakeholder. The first one is customer. So customer will have nothing to receive from the business. So this is definitely incorrect. So employees will get their salary per month. So they do not have concern with credit risk. Again, for the government as well, they will receive tax on the profit. So they do not have any concern with credit risk. Then we have suppliers, which are definitely concerned with credit risk, because if there are chances of the company going default, then it will mean that the supplier will not get their money for the credit purchases made by that particular company. So our correct answer is option D. Let's move towards the 20th question. Which statements describe the limitations of accounting information? The first one is that the businesses in the same industry may use different accounting policies. This is true because one business might decide to depreciate their non-current asset on straight line method, whereas another business might depreciate it on a reducing balance method. So their net book value will definitely differ. So there can be no correct basis for comparison. The second one is non-monetary aspects of a business are excluded from financial statements. This is true because we do not really write down how skilled employees we have. Those are the non-monetary aspects. So we have no comparison for those things. The third one is results of accounting ratios are based on the use of historic cost. This is true as well because we only figure out the values for the events that have already occurred, such as the sales that have already been made, the profit that have already been made, not the future or anticipated profit. So these are definitely based on historic cost. So we're looking for 1, 2, 3, which is given in option A. That's the correct answer. Let's move towards the 21st question. A company provided the following information at the end of its first year of trading. We need to figure out the trade receivables turnover. The formula is trade receivables divided by credit sales multiplied by 365 days. Okay, so we are given trade receivables right here, that's 4,100. We're given credit sales right here, that's 27,000 multiplied by 365. This gives a value of 55.43. We have to round it off. That will be 56 days. This is given in option C. Let's move towards the 22nd question. A company's profit from operations during a year was 128,000. Interest payable was 8,000. The following amounts were included in the company's statement of financial position at the year end. we need to figure out the return on capital employed. So the formula is our profit from operations divided by capital employed multiplied by 100%. We are given profit from operations to be 128,000. We need to figure out our capital employed. And remember that the capital employed is just the sum of our equity and non-current liabilities. So we're looking for this value. Okay, let's utilize our accounting equation. That's non-current asset plus current asset will be equal to equity plus non-current liabilities plus current liabilities. We have our non-current assets to be 485,000. We have net current assets. So net current assets is just current assets minus current liability. So if you bring this to this side, then the value for that term will be 27,000. This will be equal to our equity plus non-current liabilities, which is what we're looking for. So our capital employed is just going to be 485,000 plus 27,000, which results in 512,000. And our return on capital employed is 128,000 divided by 512,000 times 100%, which results in 25%. That's given in option D. Let's move towards the 23rd question. Which business functions would benefit from just-in-time management of inventory? So we're concerned with inventory, which means that we're only looking at departments that will have to deal with inventory or the produced goods. The first one is administration. So administration does not really look after the manufacturing of goods or the production process. So this is incorrect. The second one is distribution. So distribution is concerned with selling the produced goods. So definitely it's interested in the management of inventory, so that's correct. The third one is production, which is directly linked to our inventory management. That's true as well. And the fourth one is research and development. So research and development is not really concerned with inventory. They're only concerned with the kind of materials to be used or the kind of inventory to be used, but they're not really concerned with when the inventory comes in and goes out of the business. We're looking for 2 and 3, which is given in option D. Let's move towards the 24th question. A business pays its employees on a timely basis at 8 per hour. It also pays a weekly bonus of 1.20 for every unit of production over 100 units, plus an additional 0.80 per unit for all production over 120 units. Employees are guaranteed a minimum weekly wage of 335. An employee worked 37.5 hours last week and produced 129 units. What was the employee's wage for that week? So first of all, we need to calculate the hourly rate. The number of hours worked is 37.5. We need to multiply it by the rate per hour, which was 8. Then there is a bonus of 1.20 for every unit of production over 100 units. And over 100 units, there are 29 units. So for 29 units, they will be getting 1.2 per each unit. Then there's an additional 0.80 bonus per unit for all production over 120 units. Over 120 units, there are 9 units. So for 9 units, there will be 0.80 as well. So that gives 300 plus 34.8 plus 7.2, which results in the total of 342, which is given in option B. Let's move towards the 25th question. Which type of business is most likely to use a job costing system? So job costing system is used for a special job, which cannot be done in batches. So we're looking for that particular thing. The first one is an aircraft manufacturer. That's the correct answer, because we cannot really manufacture aircraft in bulk or in a batch, right? But if you take a look at other options, we can see that there's paint manufacturer. A paint manufacturer will not just prepare 1 liter of paint. They will prepare it in batches of bulk. So this is incorrect. The third one is a pet food manufacturer. Again, that's the same case. They will produce the pet food in bulk or in batches. That's incorrect as well. And a stationery manufacturer as well. So a stationery manufacturer will not create a unique pencil for each new product, right? They will create the same pencil in batches. So that's incorrect as well. Let's move towards the 26th question. Which statement describes a cost center rather than a cost unit? So cost center is the root cause of the cost, or where the costs actually incur. We're looking for that. The first one is a location where only variable costs are incurred. We're not concerned with only variable costs. We need to include both our variable costs as well as the fixed costs. So this is incorrect. A measurable part of a product or service. Again, this does not include the incurring of cost at all. So this is incorrect as well. The third one is a part of a product or a service for which costs are calculated. So we're not concerned with the calculation of costs, we're concerned with the incurring of costs. This is incorrect as well. And the fourth one is any location where costs are incurred. That's the correct answer. Let's move towards the 27th question. A business marks up all of its products by 20% on total cost to calculate a selling price. Each unit of product uses 4 hours of direct labor and 2 kilos of direct material. The correct overhead absorption rate to be used is 8 per direct labor hour. In error, the bookkeeper used a rate of 13 per direct labor hour. Okay, so the correct cost or correct overhead should have been 8. This is per direct labor hour, so we just need to multiply it by our direct labor hour of 4. That gives the cost to be 32. But the incorrect rate was 13. So the incorrect cost was 13 times our direct labor, which is the same. That's 4, which results in 52. So we're looking at the difference now. So the difference in cost is just 52 minus 32, which is 20. So we have charged additional 20. Or we can just say that our cost has been overstated by 20. Now we're looking for the effect of this error on the selling price and not the cost. Remember that the costs are inflated by 20% in order to figure out the selling price. So if our cost has been overstated by 20, the selling price will be overstated by 20 multiplied or increased by 20%. So that's just 20 times 1 plus 20% because we're utilizing markup on cost to figure out the selling price. But this is selling price overstated. This gives the value of 24, which is the correct answer we're looking for. That is given in option D. Let's move towards the 28th question. The following budgeted information is available for a business. We're given fixed cost, profit, as well as variable cost. We need the budgeted break-even point in sales revenue. So the formula for budgeted break-even point in sales revenue is our fixed cost divided by contribution per unit. This gives our break-even point in units. And in order to figure this out in revenue, we just need to multiply it by selling price per unit. And remember that both the numerator and the denominator has per unit. So we can basically cancel this out because if we write down fixed cost divided by total contribution divided by number of units, this will give the contribution per unit, right? Similarly, if we multiply it by the total revenue and divide it by the number of units, this will give the selling price per unit. So we can just cancel the number of units on both the numerator and the denominator, giving the formula to be fixed cost divided by our total contribution multiplied by the total revenue. And we're doing this because we're not given any information regarding the number of units and we're given the cost in terms of total costs. Okay, so we have the fixed cost of 120,000. We need to figure out the total contribution. Okay, so we know that revenue minus variable cost minus fixed cost will result in profit. We are not given information regarding revenue. The variable cost is 52,000. The fixed cost is 120,000 and the profit is 88,000. So our revenue will just be 88,000 plus 52,000 plus 120,000, which gives the total to be 260,000. Alright, let's figure out our total contribution as well. That will be revenue minus variable cost. We just figured out the revenue to be 260,000. The variable cost is 52,000, which gives the total contribution to be 208,000. So that's 120,000 divided by 208,000 multiplied by 260,000. This gives the budgeted break-even point in sales revenue to be 150,000. This is given in option B. Let's move towards the 29th question. A business provided the following information about its total costs. Alright, 1,000 units had been manufactured and sold for 200 each. This is the selling price per unit. Now we need to figure out the contribution per unit. So the formula for contribution per unit is selling price per unit minus variable cost per unit. And we can see that we're given the variable cost in terms of total cost. So in order to figure out the per unit cost, we can just divide the total by the number of units, which is 1000 in this case. Okay, so let's figure out variable cost per unit. First of all, we need to figure out the total variable cost. Direct material and direct labor is a variable cost. Factory expenses, these are given to be variable. And we also have selling and distribution expenses, which is variable. So our total variable cost is 84,200 plus 15,700 plus 18,100. Now, in order to figure this out per unit, we just divide it by 1000. This gives our variable cost per unit to be 118. So our selling price per unit is 200 minus the variable cost per unit is 118, which gives the contribution per unit to be 82. This is given in option B. Let's move towards our 30th question. Which items are included in the marginal cost of a unit production? So in marginal cost, we include all of our variable cost and our production overhead. And we only include the variable production overhead. And the variable cost just refers to our direct costs, such as the direct material or direct labor. Okay, so for the first option, we have direct labor, direct materials. We have fixed production cost, which is incorrect. So that's incorrect. The second one is direct labor, direct materials. Again, there's fixed cost, which is incorrect. For the third one, we have direct labor, direct materials, and variable production overheads only. That's the correct answer. For the fourth one, we have direct labor and direct materials only. So we're missing variable production overheads in this case. So that's incorrect. Alright, this concludes paper 1-3 for May June 2023. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.